Okay, welcome to the Chapter 3, Business Transactions and Accounting Equation presentation lecture. Please make sure that you have the demo problems printed off and with you, as well as access to the Chapter 3 notes, which are all available to you on Google Classroom. Please make sure that you download and print those so that you have those available to you. If you do not have them available to you and you do not have the ability to print, then please make sure that you just follow along and take notes in a notebook as we go through the demonstration problems and the different concepts of business transactions and the accounting equation. All right, let's start off with section 3.1, which is property and financial claims. Property. Let's take a look at property and quickly take a look at what property might be. You own property right now. You are wearing property. What items of property are you currently wearing? A shirt, a sweatshirt, a pair of pants, a pair of shorts, a pair of shoes. All of those will be considered property because they are items that you own and you're currently wearing them. You stake claim to them. They are your property. What rights do you have to this property? Well, if you've purchased it or if it has been given to you as a gift, you are the sole claim right or the sole right to this property. This is your claim. It is yours. You share it with nobody else. What types of property might you share rights with another person? You might, for example, be sharing an automobile with a brother or sister, in which case you have a claim to that property as well as your sibling, your brother or sister having a claim to that same property. So how can we define property? Property is basically anything of value that is owned or controlled. Okay, please take out demo problem 3.1. Let's take a look at this. Now you've bought a coat for $60 cash. We are going to take a look at this in equation form. What is the relationship between the property and your financial claim? Well, the property is the coat, and the coat has a value of $60. You paid for this coat with cash out of your own pocket, which is your financial claim, so the property equals the financial claim. $60 equals $60. Balancing and equaling equations is going to be a common theme in Accounting 1, and once we get to the accounting equation later in this chapter, you'll see how all of this comes together. So, a little bit more on property. When it comes to property, you need to know that a financial claim is the legal right to any item. When you purchase with cash, you have all the property right or financial claim to that item. If you purchase it with credit, you do not. So what happens when you buy on credit? Well, when you buy on credit, you now are going to buy it now, but you are going to agree to pay for it later. The creditor, the person selling you the property on credit, if you buy anything on credit, they will actually have a financial claim on what you've invested. So for example, if you buy a bike lock for $100, you pay $60 cash for it, and you borrow $40 to cover the cost of that bike lock, the creditor's claim is $40 value of that bike lock. Your claim is $60. 60 plus 40 equals the $100 value of the bike lock. Now, financial claims and how they relate to accounting. What you need to know is assets, which is an account classification, which we'll get into a little bit later, property or items of value owned by a business. Equity, this is an accounting term for financial claims to assets. They can be usually they are by the owner. Owner equity is another account classification that we will be discussing later. Investment, these are assets that are long-term or will not be used up or converted to cash. These could be any pieces of equipment that the owner decides to invest in the business. We would classify that as an investment financial claim. All right, now let's take a look at demo problem number 2. The scenario is that you want to buy a bicycle that costs $200, but you only have $45. However, E&T Sports Stores is going to agree to sell you the bicycle on credit. You're going to pay the $45 down and sign an agreement to pay the remaining $155 in payments. You are going to show this in the grid down below by using property equaling financial claims. Property is the bicycle. The bicycle is valued out at $200. Now, in order to pay for that, there are going to be two entities or two parties that are going to have financial claim. The creditor is going to have a $155 financial claim to that $200 bicycle, and the owner is going to have a $45 claim to that $200 bicycle. In order to make sure that property equals financial claim, $200 equals 155 plus 45. Okay? And see how that all fits together, making the equation equal, balancing it out. All right, one more time. Roadrunner Delivery Service purchases a delivery truck for $10,000. They make a $3,000 down payment and get a loan for the remaining amount. Property is the truck. The truck is valued at $10,000. The creditor's financial claim is $7,000. That is the amount that had to be borrowed in order to purchase the truck. The other party who has financial claim to this truck is the owner, and the owner's financial claim is $3,000. So making the accounting equation equal, $10,000, the value of the truck, is going to equal $7,000, the creditor's financial claim, plus $3,000, the owner's financial claim. If we break this down into the base equation that all accounting is done and based off of, that is that all assets equal, assets being the property, are going to equal all liabilities, which is creditor's financial claims, plus the owner's equity, which is the owner's financial claims. So if we put all that together, we have an accounting equation known as assets equaling liabilities plus owner's equity. Assets are the value of what the business owns. Liabilities are value of the creditor's claims. And owner's equity is the value of the owner's claims. All right, moving on to section 3.2, transactions that affect owner's investments, cash, and credit. Again, a review of the accounting equation. Assets equals liabilities plus owner's equity. That is the base of accounting. Making that equation equal is what all accountants need to do. Now, tomorrow when we get to class, we are going to complete the sorting activity. You'll get a chance to take a look at different classifications of accounts and the account titles and put them into the proper classifications. Now bring out demo problem number 3.3. Same day cleaners just bought a new cash register for $2,400. The business made a down payment of $400 and borrowed the remaining $2,000 from a local bank. Now let's apply the accounting equation. Remember, the accounting equation is assets equaling liabilities plus owner's equity. So what is the asset in this particular transaction? The asset is the item being purchased. That's the new cash register for $2,400. What is the liability? That is the creditor's claim to this asset, which is $2,000. And what's the owner equity? That is the owner's financial claim to this particular item, which is $400. So assets, $2,400 equaling $2,000 in liabilities plus $400 in owner's equity. The accounting equation balances, it equals. Now let's take a look at business transactions. Business transaction is an economic event that causes a change in assets, liabilities, or owner's equity. Anytime values of accounts, money changes hands, a transaction has taken place and it needs to be recorded. These transactions are going to affect accounts. Anytime an account balance is going to change, whether it's going to increase in value or decrease in value, a transaction is taking place. An account is going to show the balance for each specific item. We give those items account names. So some common accounts that you might see in most businesses when it comes to accounting. Accounts receivable, that's any money owed to us as a business. Those are our customers. Accounts payable, that is money that we owe to creditors. Those sometimes are called our vendors. All right, now let's take a look at demo problem 3.4. Please take that out and let's go through the different steps of completing that. In order to complete that, you'll need to realize that we have five different accounts. We have 3 asset accounts: cash and bank, accounts receivable, computer equipment, accounts payable, and M. Crabtree Capital. Analyzing the business transactions. In this demo problem, you are going to identify the accounts that are affected. Then you are going to classify the accounts that are affected. Are they an asset, a liability, or owner's equity? Then you're going to determine the amount of increase or decrease for each account for each transaction. And then finally, the balance, make sure that the accounting equation remains in balance. So investment by owner, Maria Sanchez took $25,000 for a personal savings account. She is going to put that into her business's checking account in the name of Roadrunner Delivery Service. So your responsibility on your demo problem, identify the accounts affected, classify the accounts affected, determine the amount of increase or decrease for each account. Make sure the accounting equation remains in balance. You're going to do this for every single transaction associated with this demo problem. So here's the next one. Another investment by owner. Again, make sure that you are doing the 4 steps. Identify, classify, determine the increase or decrease, and then balance the accounting equation. Pause the presentation lecture at any time if you need to as you complete the demo problem. Cash payment transactions. A little bit different type of clue, but again, the same process. Identify, classify, determine increase, decrease, and then balance the equation. Credit transactions. This is an example of a credit transaction clue. Same thing holds true, the 4-step process. Identify, classify, determine increase, decrease, and then balance the equation. Another credit transaction, same thing, follow the 4-step process. On account, which is underlined in this clue, is a big clue. On account means liability. So chances are one of the accounts that are affected is going to be a liability classification. So again, go through the 4-step process. Pause the presentation lecture if needed. Another credit transaction, determine in the clue, identify, classify, determine increase or decrease, balance the equation. Another credit transaction, again, following the 4-step process. Pausing the presentation lecture if needed. Section 3.3, which is transactions that are going to affect revenue, expenses, and withdrawals by the owner. Now, revenue and expense transactions. Revenue, income earned from the sale of goods. That is money coming in. Any money coming in is considered a revenue. An expense is the price paid for goods or services used to operate a business. Money going out. Money coming in, revenues, money going out, expenses. And then finally, withdrawals, which is the owner's prerogative to take cash or other assets from the business for personal use. So how are we going to log transactions that are going to affect revenues, expenses, and withdrawals? We are going to do the same step-by-step process. Now we have a revenue and expense transaction. Here is the clue. Again, 4-step process. Identify the account affected, classify the account affected, determine increase or decrease for each account, and then make sure that you balance the accounting equation. Another one, another revenue and expense transaction. There is the clue. Decipher the information in the clue. Follow the 4-step process. Again, pausing when needed. Withdrawal transaction. Here's what the clue would look like. Go through the 4-step process. That concludes all the different transactions. We will go through the demo problem answers in class tomorrow to see how well you did. So if you have to, go back, revisit any of the slides in order to make sure that you can complete the demo problems. We will go over the results next time we meet in class, and I look forward to seeing you then.